ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. A quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect? Average accounts receivable over net credit sales times 365. How many days to collect? 365 over accounts receivable turnover. How many days to collect? Ending accounts receivable over net credit sales times 365. How many days to sell? Average inventory over cost of goods sold times 365. How many days to sell? 365 over inventory turnover. How many days to sell? Ending inventory.
Welcome again. We are back to work. All right. See if everything is in order. Okay. Today is already Friday, so let's get to work. Father God, we thank you for this beautiful day. Thank you for giving us the opportunity to get back to study. We ask you, Lord, for knowledge, for intelligence that comes from you. Give us wisdom, give us understanding, so that we can understand the material. Help us, Lord. Lead us. Take control. We pray in Jesus' name. Amen. Amen. All right. Let's go. Let's do it. All right, our first question. To measure inventory management performance, a company monitors its inventory turnover ratio. Listed below are selected data from the company's accounting records. Annual sales for the current year is $2,525,000. Prior year, $2,125,000. Gross profit percent, we have 40% of current year and 35% of prior year. Beginning finished goods inventory for the current year was 15% of the prior year's annual sales. Beginning finished goods inventory for the current year was 15% of the prior year's annual sales. And ending finished goods inventory was 22% of the current year's annual sales. What was the company's inventory turnover at the end of the current period? What is inventory turnover? Inventory turnover is cost of goods sold divided by average inventory. All right, cost of goods sold divided by average inventory. Do we have cost of goods sold? Let me see. We have sales, annual sales. We have gross profit. Cost of goods sold. Current year gross profit. All right, so we have gross profit and we have sales. If we have gross profit, we have sales, we can find cost of goods sold, because cost of goods sold can be sales minus gross profit, right? So sales is 2,525,000. Gross profit is 40% of this for current year. So 60% of this number is cost of goods sold. Okay? 60% of this is cost of goods sold. So what I'm going to do is 60% of 2,525,000. 2,525,000 times 60% is 1,515,000. So cost of goods sold for current year is 1,515,000. Cool. This is 60% of 2,525,000. Right? So if they give me annual sales, they give me gross profit, I can't find cost of goods sold, because total sales, here we have total sales, we have gross profit, it's going to be total sales minus gross profit. Cost of goods sold will be annual sales minus gross profit. So even though we have the percent, so we do the percent and then we can get it. Excellent. So we have we have cost of goods sold. Do we have average inventory? Not yet. They say beginning finished goods inventory for the current year was 15% of the prior year's annual sales. So prior year is 2,125,000. They tell us that the beginning finished goods inventory, that means the beginning inventory for current year, is 15% of prior year's sales. So 15% of the 2,125,000. This is beginning inventory. Okay, so I will just explain it. All right, so this is beginning inventory, and ending inventory. It says an ending finished goods inventory was 22% of the current year's annual sales. So ending inventory is 22% of 2,525,000. So based on that, we have beginning inventory, we have ending inventory. So average inventory is beginning inventory plus ending inventory divided by 2. So once we have that number and we already have cost of goods sold, we can find the result. Okay, we can find it. Let's move forward. The number is not important. What's important is the idea, is how to do it. A company has the following items on its year-end trial balance. A company has the following items on its year-end trial balance. We have net sales, we have common stock, we have insurance expense, wages, cost of goods sold, cash, accounts payable, interest payable. The question is, what is the company's gross profit? What is the company's gross profit? Gross profit, we have net sales. Gross profit is net sales minus cost of goods sold. That's it. Net sales minus cost of goods sold. So we have net sales. We have cost of goods sold. Net sales is 500,000. Cost of goods sold is 100,000. So gross profit will be 400,000. That's it. Okay. So what is the company's gross profit? Gross profit is net sales minus cost of goods sold. Even if they give you a lot more numbers, don't worry about them. Just ignore them. Net sales equals what is the company's gross profit equals net sales minus cost of goods sold. Net sales minus cost of goods sold. That's what it is, all right? Gross profit equals net sales minus cost of goods sold. Gross profit equals net sales minus cost of goods sold. Gross profit equals net sales minus cost of goods sold. Gross profit equals net sales minus cost of goods sold. We can remember that. The following financial data pertains to Carlo Corporation for the current year ended December 31st. Net income, we have net income, we have cash dividends, we have market price of stock, we have earnings per share. The question is, what is Carlo's dividend payout ratio for the current year? Dividend payout ratio, I need this formula, the formula. Dividend payout ratio is cash dividend divided by net income. Dividend payout ratio, cash dividend divided by net income. Dividend payout ratio, cash dividend divided by net income. Dividend payout ratio, cash dividend divided by net income. Cash dividend divided by net income. Dividend payout ratio. Dividend payout ratio, cash dividend divided by net income. All right, dividend payout ratio is cash dividends divided by net income. It measures the percent of earnings distributed on the form of cash dividends. It measures the percent of earnings distributed. Measures the percent of earnings distributed in the form of cash dividends. Measures the percent of earnings distributed. How much money was distributed in the form of cash dividends? Comparing to net income. Okay, compared to the money that was received, that was made, compared to the money that you made, how much dividend did you pay? Dividends payout ratio. Dividends payout ratio is cash dividend. How much dividend did you pay based on how much income did you had? How much dividend did you pay based on how much income the company had? So it's going to be dividends, cash dividends divided by net income. How much dividend did you pay compared to what? To the income, to the net income of the company. So it's going to be cash dividends divided by net income. This is dividend payout ratio. Okay. Dividend payout ratio measures how much dividend you paid. How much cash dividend measures the percent of earnings distributed. All right, how much money you paid, how much cash dividend you pay compared to the net income of the company. Dividend payout ratio. Makes sense, okay? So remember, earnings per share. What is earnings per share? Earnings per share is net income minus preferred dividend divided by weighted average of common shares outstanding. Remember that. Okay, so this is EPS, earnings per share. Measures net income earned on each share of common stock. This measures net income earned on each share of common stock. So net income, earnings per share. So how much earning did you earn per share? Measures net income earned on each share of common stock. But you need to subtract preferred dividends. That's why you say net income minus preferred dividend, because preferred dividend goes to the preferred people, the preferred stock people. So, but you're calculating a common stock. So you need to subtract preferred dividend, and then you do the weighted average of common shares outstanding divided by weighted average of common shares outstanding. Okay, we have price earnings ratio. Price earnings ratio, it's price divided by earning, right? Market price per share divided by earnings per share. Okay, remember that. Market price per share divided by earnings per share. Okay, so remember that. It measures the ratio of market price per share to earnings per share. Okay, that's good. This is good. Which of the following is not a profitability ratio? Which of the following is not a profitability ratio? Okay, so let me go through. We have price earnings ratio, return on asset, gross margin, operating profit margin. So, price earnings ratio. The price earnings ratio is a market ratio. It is calculated by dividing the price of a share of stock by earnings per share. Okay, price earnings ratio is the market price per share divided by earnings per share. This is not a profitability ratio. This is not a profitability ratio. It is a market ratio. Okay. The next one, return on asset. Return on asset is a profitability ratio. Okay. Gross margin is also a profitability ratio. Operating profit margin is a profitability ratio. The one that is not a profitability ratio is price earnings ratio, which is a market ratio. The following financial data for Lalo Corp for the last 2 years. We have a lot of information. It's like a lot. So let's see the question. For 2022, calculate inventory turnover for Lalo. What is inventory turnover? Inventory turnover is cost of goods sold divided by average inventory. Let me see if they gave us cost of goods sold. It's a lot of information. I don't even want to read all of this. But we need to know it's cost of goods sold divided by average inventory. All right, current long-term stockholders total. Cost of goods, yeah, okay. We have cost of goods sold is $400,000. Now, do we have average inventory? Let me see number. Accounts receivable inventory. Okay, here we have inventory. We have inventory. Year 1, 2001, 30,000, 2002, 40,000. So it's in average inventory is beginning inventory plus ending inventory divided by 2. So here we will have 30,000 plus 40,000 divided by 2. So it's going to be 70,000 divided by 2. So average inventory will be 35,000. It will be 35,000. And cost of goods sold is 400,000. So we will say 400,000 divided by 35,000. 400,000 divided by 35,000. Yes. Let me see. 400,000 divided by 35,000. It's 11.42. Okay, 11.42. And that's what it is. Okay. Yes. All right. So even if if I could show you, I would show you all of the information that they provide on this question. But the only thing you need based on the question they ask is inventory turnover. Inventory turnover is cost of goods sold divided by average inventory. You find cost of goods sold, it's already provided. You find average inventory, which is beginning inventory plus ending inventory divided by 2. Now you have cost of goods sold, you have average inventory, you can find the answer. Does corporation's total current assets, all right, does corporation total current assets exceed the total current liabilities? The balance sheet reports the cash and accounts payable balance as $25,000 and $50,000 respectively. If the company makes $10,000 payment to creditors, what will it do? Will it decrease current ratio or increase current ratio? Will it decrease working capital or increase current capital? What's going to happen? This one, I want to get the explanation, because for me, this would trick me, but not anymore. Okay, so it's okay. Just a second. Current asset current ratio minus current liabilities. Current asset current ratio minus current ratio current asset over current liabilities. Current ratio equals current asset divided by current liabilities. Okay, so let's go understand this question right here. Okay, this is a classic current ratio rule question. Step 1, identify what's happening. The company pays $10,000 cash to creditors. Okay, the company pays $10,000 cash to creditors. Journal entry: accounts payable $10,000, cash $10,000. So current assets goes down $10,000. Current liabilities goes down $10,000. You hear that? Current assets goes down $10,000. Current liabilities goes down $10,000 because the corporation's total current asset exceeds the total current liabilities. This is an important information. The balance sheet reports the cash and accounts payable balances as $25,000. So cash balance is $25,000 and accounts payable balance is $50,000. Okay, cash balance $25,000, accounts payable $50,000. So we have asset $25,000, liability $50,000. But what happened? The company takes $10,000 from its $25,000 cash to pay on the $50,000 of liabilities. What happened? Money goes out of cash to go to liability. So current asset goes down, current liability also goes down. Step 2, remember the shortcut. When current ratio is greater than 1, current assets exceed current liabilities, and you pay off a current liability, current ratio increases. Remember that. Listen to this again. Remember the shortcut. When current ratio is greater than 1. When current ratio is greater than 1, that means current assets exceed current liabilities, which is what was said. This is what they said in the question. The corporation's total current assets exceed the total current liabilities. Okay, total current assets exceed total current liabilities. That means The ratio is greater than 1. The ratio is greater than 1. Now, guess what happens? And you pay off a current liability, current ratio increases. Why? Because you are subtracting the same amount from a larger number and a smaller number. Okay? That makes sense. Quick example. Suppose current assets is $100,000. Current liabilities is $50,000. Current ratio is 100,000 divided by 50,000. That equals 2. After paying $10,000, you take $10,000 from your current asset, which is from your cash or whatever, and you pay current liabilities, which is the $50,000. So what's going to happen? After paying $10,000, current assets will go down to 90,000. Current liabilities will go down to 40,000. So new current ratio will be 90,000 divided by 40,000. It will be 2.25. Ratio increased from 2.0 to 2.25. Therefore, when you take money from, first of all, we need to understand that if current assets exceeds current liabilities, and you take money from current asset to pay current liabilities, your current ratio will increase. Your current ratio will increase. Some of you may say, hey, current ratio is going to go down because you're taking cash. You're taking cash because what? You're taking from your quick asset to pay your liability, so your current ratio is going to go down. No, current ratio will not go down. Current ratio actually will go up because your current ratio, your current asset exceeds your current liabilities. When you take money, it's just like you make a transfer of funds from your asset to your liability. So your asset will go down, your liability will go down. So current ratio, what is current ratio? It's current assets divided by current liabilities, right? So if you remove 10,000 from each one of them, both will go down. So that's why your current ratio will increase. Current ratio will increase. All right. I think I understand that. I think I understand it. All right. Think we understand. Current ratio is current assets divided by current liabilities. Current ratio is current assets divided by current liabilities. Quick ratios is quick assets divided by current liabilities. Quick ratio is quick assets divided by current liabilities. Okay, so let's go to the next question. Kraft Corporation had 100,000 shares of common stock and 50,000 shares of non-cumulative and non-convertible preferred stock issued and outstanding. Additional information for December 31st of the current year is as follows. Net income is $1,200,000. Dividends on preferred stock is $300,000. The market price per share of common stock on December 31st is $72. What is the company's December 31st price to earnings ratio? What is the formula for price to earnings ratio? The answer is in the question. Price to earnings is market price per share divided by earnings per share, okay? Price to earnings ratio The answer is in the question. Price to earnings ratio is the market price per share or price per share divided by earnings per share. Price to earnings ratio. So do I have market price? I do have, because they say market price per share of common stock on December 31st is $72. So I have market price per share. Do I have earnings per share? Earnings per share is EPS. How do you calculate earnings per share? Earnings per share equals net income minus preferred dividend divided by weighted average of common stock. Hey, remember that formula. Earnings per share, which is EPS, earnings per share equals net income minus preferred dividends divided by a weighted average of common stock. Do I have preferred dividend? Yes, I have preferred dividend. They say dividends on preferred stock is $300,000. Do I have net income? Yes, I have net income. It was provided. They say net income is $1,200,000. So I have net income. I have preferred dividend. Do I have weighted average of common stock outstanding? Weighted average of common stock outstanding. I have net income, dividend on preferred stock. I have dividend on preferred stock. Do I have weighted average of common stock outstanding? It says had 100,000 shares of common stock. All right, so it's 100,000. So I think we have everything we need to calculate that. Okay, so in this scenario, the company's ratio is 8-1 as calculated below. Is $1,200,000 net income minus $300,000 preferred dividend. Okay, so this is $900,000. What is weighted average of common shares is 100,000. So no information was given concerning any changes in the number of shares outstanding during the year. So it's 900,000 divided by 100,000 equals $9 earnings per share. So $9 earnings per share. What are we calculating? We're calculating price to earnings ratio. Price to earnings ratio is market price per share divided by earnings per share. So we calculated earnings per share, which is 9. Market price is 72. So it's going to be market price divided by 9. 72 divided by 9 is going to give us the answer, which is 8 point something. Okay. 8.0 to 1. That's good. The following information pertains to Foxco for the calendar year 2. What do we have? They gave us sales on credit. Sales on credit, $2 million. Gross profit on sales, $900,000. Net income, $150,000. Purchases, $1 million. Inventory at end of year, $200,000. Accounts receivable at beginning of year, $600,000. Accounts receivable at the end of year, $400,000. Stockholders' equity at the end of year. Common stock outstanding, unchanged during the year, minus 300,000 shares is 300,000 at par of $1 per share. Retained earnings is 500,000. The total is 800,000. Dividends paid during the year, total $0.25 per share, 25 cents per share. The market price per share of Fox stocks of the stock was $5 at the end of the year. Fox inventory turnover for year 2 what is the inventory turnover for year 2? Inventory turnover is inventory turnover cost of goods sold divided by average inventory. That's the formula. Inventory turnover is cost of goods sold divided by average inventory. So do we have cost of goods sold? We have sales on credit. We have gross profit on sales. We have net income. We have purchases. We can find cost of goods sold. We can find cost of goods sold because we have sales, but these sales are on credit. We have gross profit on sales. We have gross profit. We have net income. We have purchases. So cost of goods sold equals beginning inventory plus purchases minus ending inventory. We can use this formula. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. This is one formula to calculate cost of goods sold. Do we have beginning inventory? We have inventory at end of year. Gross profit on sales, net income, purchases, inventory at end of year. We have inventory at end of year. Accounts receivable at beginning, accounts receivable at the end, stockholders equity. All right. So we have ending inventory. We don't have beginning inventory. Should we go look for it, or is there another formula we can use to find cost of goods sold? Cost of goods sold. We have sales. We have sales, but we have purchases. Purchases, we have net income. There should be another formula to find cost of goods sold. Or we should go find beginning inventory. If I have ending inventory is 200,000. I have purchases. Okay. So how ending inventory? I have ending inventory. I have purchases, which is 1 million. So this is what you purchased during the year. Sales on credit, 2 million. If you sold for 2 million, okay, you had sales for 2 million. You purchased for 1 million. And you have $200,000 left. This will give me cost of goods sold, right? So you have sales for 2 million. You have sales for 2 million. So that's 3 million minus 2 million. 200,000. That's what it should be. No. All right. So it's getting me confused. That should be, if I take some time, I can do it, because I can't find cost of goods sold. Is you sold for sales 2 million. Sales 2 million during a year. Okay. If you sold for 2 million, but you had purchases 1 million. You had purchases 1 million. You sold for 2 million. And you have inventory at the end of the year of 200,000. So how much inventory did you have total during the year? Total inventory. Purchases. This is taking me too much time. Let me do that. Okay. Let me do that. This is taking too much time. All right, so I have sales on credit of $2 million. Gross profit on sales $900,000. Net income $150,000. Purchases $1 million. Inventory at the end of year is $200,000. Okay, so the question is asking me for inventory turnover. The question is asking for inventory turnover. How do I get inventory turnover? We have more information, but the cost of goods sold divided by average inventory. Yes. Let's see what information we have. Sales, gross profit. All right, so find cost of goods sold. Gross profit equals sales minus cost of goods. Oh, that's the formula. Gross profit equals sales minus cost of goods sold. Therefore, 900,000 equals 2 million minus cost of goods sold. So cost of goods sold will equal 2 million minus 900,000. Cost of goods sold is 1,100,000. Okay. So we have cost of goods sold. Average inventory is beginning inventory plus ending inventory divided by 2. But they only gave us ending inventory, which is 2,200,000. We need beginning inventory. Yes, that's what I was saying. Yeah. We need beginning inventory. So how you find beginning inventory? Beginning inventory plus purchases minus cost of goods sold. Yes, that's what I was trying to find. But now we have cost of goods sold. How did cost of goods sold was provided to us already? Let me see. Sales, gross profit, net income, purchases, inventory at the end of year, accounts receivable, accounts receivable, stockholders common. Oh, we didn't have cost of goods sold. Yeah, okay, so we found cost of goods sold. What is the formula we used for cost of goods sold? All right. Gross profit equals sales minus cost of goods sold. All right, so we have gross profit, we have sales, we need cost of goods sold. We can use this formula. Gross profit equals sales minus cost of goods sold. So here we can find cost of goods sold. And then to find beginning inventory, we use the other formula. Beginning inventory plus purchases minus cost of goods sold. Okay, so to find beginning inventory, use beginning inventory plus purchases minus cost of goods sold. Beginning inventory plus purchases minus cost of goods sold. Beginning inventory equals 300,000. So you can find average inventory. So that's going to be 4.4. Okay. There are several formulas to find cost of goods sold. All right. So cost of goods sold equals, is that a formula? Cost of goods sold equals beginning inventory plus purchases minus ending inventory. That's a formula. And we can use the other one, which is gross profit equals sales minus cost of goods sold. Is there any other formula to calculate cost of goods sold? Cost of goods sold, beginning inventory plus purchases minus ending inventory. Think what was available for sell. What is left? what was sold. Example, 300,000 plus 1 million minus 200,000. Gross profit formula. Gross profit equals sales minus cost of goods sold. Rearrange cost of goods sold equals sales minus gross profit. Yes. Cost of goods sold equals sales minus gross profit. Cost of goods sold equals sales minus gross profit. You have that. Yes, cost of goods sold equals sales minus gross profit. Cost of goods sold equals sales minus gross profit. Yes. All right. Cost of goods sold equals sales minus gross profit, or cost of goods sold equals beginning inventory plus purchases minus ending inventory. What are the formulas that we need to find beginning inventory? Beginning inventory equals cost of goods sold plus ending inventory minus purchases. Beginning inventory equals cost of goods sold plus ending inventory minus purchases. Okay. Okay. So, all right. Beginning inventory equals cost of goods sold plus ending inventory minus purchases. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. I'm looking to see what is the relationship of cost of goods sold equals beginning inventory plus purchases minus ending inventory. All right, that's cost of goods sold. Beginning inventory equals cost of goods sold plus ending inventory minus purchases. How do you play with this to find each component? If each component, whenever one of these component is unknown, how do you play with this? Beginning inventory plus purchases minus cost of goods sold. Think of it as what you started with plus what you bought, what you sold, what's left equals what's left. So for cost of goods sold, starting equation, beginning inventory plus purchases minus cost of goods sold equals ending inventory. Beginning inventory plus purchases minus cost of goods sold. Move cost of goods sold to the other side. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. So cost of goods sold equals beginning inventory plus purchases minus ending inventory. So for beginning inventory plus purchases minus cost of goods sold equals ending inventory. Subtract purchases. Beginning inventory minus cost of goods sold equals ending inventory minus purchases. Add cost of goods sold. Beginning inventory, you're getting me confused now. Purchases equals cost of goods sold plus ending inventory minus beginning inventory. Purchases equals cost of goods sold plus ending inventory minus beginning inventory. Okay, so we can play with this. So you are providing too much information. What I need is how to rearrange and solve for each with a short explanation why I rearrange it in that form. For example, when we say beginning inventory plus purchases minus ending inventory equals cost of goods sold. So I'm solving for cost of goods sold. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. If I'm solving for beginning inventory, how do I rearrange that? All right, if I'm solving for purchases, how do I rearrange it? That's what I need. All right, so start with the master formula. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. Now isolate whichever item you're solving for. Solving for beginning inventory. Okay. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. Subtract purchases from both sides. Cost of goods sold minus purchases equals beginning inventory minus ending inventory. Beginning inventory equals cost of goods sold plus ending inventory minus purchases. Beginning inventory equals cost of goods sold plus ending inventory minus purchases. Okay, I'll come back to this another time because I need to understand that. That's 4.4. All right, so this question, inventory turnover. We're looking for inventory turnover. Inventory turnover equals cost of goods sold divided by average inventory. Okay, so we found cost of goods sold. We have several formula to calculate cost of goods sold, but the one that we used was sales. Let me go back to this. Bless me. Okay. Oof. Current asset. All right, so where am I? Cost of goods sold divided by average inventory. We use gross profit equals sales minus cost of goods sold. So, all right, gross profit equals sales minus cost of goods sold. So cost of goods sold equals sales minus gross profit. Yeah. Cost of goods sold equals sales minus gross profit. Yeah. All right, so we have that already. Let's move on. What time is it? Okay. All right, we still have 18 minutes to go. All right, so let's get going. So the following information pertains to, that's the one we just did. 4.4. We got that. A company has net income of $380,000, interest expense of $50,000, depreciation expense of $75,000, and income tax expense of $110,000. What is the company's times interest earned ratio? Time interest earned ratio. Let me do that real quick because we are not going to spend a lot of time thinking through this. Time interest earned. I don't remember the formula for this. times interest earned ratio. This is time interest earned, TIE, times interest earned ratio. Times interest earned is EBIT divided by interest expense. Okay, EBIT divided by interest expense. All right. EBIT, earnings before interest and taxes. Step 1, find EBIT. You're given net income, interest expense, income tax expense. To get back to EBIT, EBIT equals net income. Alright, so give me just a second. Just a moment, be right back.
Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities.
All right.
How many days to collect? Average accounts receivable over net credit sales times 3.
All right, so let's get going. A company has net income of $380,000, interest expense of $50,000, depreciation expense of $75,000, and income tax expense $110,000. What is the company's times interest earned ratio? This is something I need to clip. Okay. Let's write the formula vertically so that it can fit on the screen. Okay. All right, so times interest earned equals EBIT divided by interest expense. This is the question. The question is asking for times interest earned. Times interest earned is EBIT divided by interest expense. Find EBIT. EBIT equals net income plus interest expense. Plug in the numbers. All right. Maybe we need to abbreviate the formula because so that it can fit on the screen. Okay. So times interest earned is EBIT divided by interest expense. Find EBIT. EBIT is net income plus interest expense plus tax. Okay, plus interest expense plus tax expense. Okay, interest expense plus tax expense. This question gives us EBIT equals $380,000 plus 50,000 plus 110,000, that's 540,000. Times interest earned is 540,000 divided by 50,000. Okay, so that makes sense. It's not too hard. So times interest earned, we need to know there are two formulas we need to memorize here. Times interest earned is EBIT divided by interest expense. We need to find EBIT. EBIT equals net income plus interest expense plus tax expense. EBIT means income, earnings before interest and taxes. Income before interest and taxes. But now, calculating EBIT, we need to plus interest in tax. Plus interest expense plus tax expense. Oh, I see what's going on. So, EBIT equals net income plus interest expense plus tax expense, because EBIT is earnings before tax, is earning before interest and tax. So if you're calculating earnings before interest and tax, you need to add interest back to net income, add tax back to net income. Make sense? Okay. So it's net income plus interest and tax. Net income plus interest expense and tax expense gives you EBIT, gives you earnings before interest and tax. That makes sense? All right. So times interest earned is EBIT divided by interest expense. EBIT divided by interest expense. Now we need to find EBIT. EBIT equals net income plus interest expense plus tax expense. That's EBIT. Because EBIT is earnings before interest and tax, which is gross profit, I would call it. Yeah, I would call it gross profit. Earnings before interest and tax. Okay, so EBIT equals net income plus interest plus tax expense. Okay, so we have what we need. We just calculated, and it is 10.8. Okay. Times interest earned is EBIT divided by interest expense. We have interest expense here, depreciation, income tax expense. We have income tax expense. We have interest expense of $50,000. So they gave us everything. So, okay, that's good. Times interest earned is EBIT divided by interest expense. We need to find EBIT. EBIT equals net income. They gave us net income plus interest expense plus tax expense. That's it. Excellent. Excellent. All right, so Carter Co. had the following items on its balance sheet at the end of the current year. Let me go all the way down. That's a lot of information. Let me go all the way down to the question. What is Carter's working capital at the end of the current year? Okay, working capital. What is the formula for working capital? What is the formula for working capital? Working capital is current asset minus current liabilities. Okay. Working capital, current assets minus current liabilities. All right. So do we have current asset? We have cash and cash equivalent, $200,000. That's part of current asset. Short-term investments, $100,000. Accounts receivable, $400,000. This is part of current assets. Inventories, we don't need that, $600,000. We have patent, 10 years, $300,000. Equipment, $1 million. Accumulated depreciation, $200,000. The amount of current liabilities at the end of the current year was $640,000. So we have current liabilities. We need current assets. Current asset, we're going to add cash and cash equivalent, $200,000. We will add accounts receivable, $400,000, so that's $600,000. What else? Equipment is not current asset. Accumulated depreciation. Depreciation is the contra asset. I think that would be deducted from total asset. But I don't want to do that. Let me just go ahead and scan it real quick. But I have the idea, but some of these things are confusing me a little bit. Are we almost there? We are almost there. Okay. Used formula. Working capital equals current assets divided by current minus current liabilities. Working capital equals current assets minus current liabilities. Step 1, identify current assets. This is what we need to identify. We have cash of $200,000. We have short-term investment, $100,000. Accounts receivable, $400,000. Inventory, yes, $600,000. Inventory is current asset. Do not include patent, long-term asset, equipment, long-term asset, accumulated depreciation, contra asset. So we have current asset 200,000 plus 100,000 plus 400,000 plus what else? Inventory plus 600,000. So that 1,300,000. Current liabilities is $640,000. So working capital is 1,300,000 minus 640,000. I believe the hardest thing here is to identify current asset. Right? Identify current assets. Cash and cash equivalent is current asset. Short-term investment. It says short-term. Short-term investments is current asset. Accounts receivable is current asset. Inventories, current asset. Okay. Patent is not current asset, is long-term, is 10 years. Equipment is not current asset, long-term. Accumulated depreciation is a contra asset. But now what I need to know, why we did not subtract accumulated depreciation. No, you cannot subtract accumulated depreciation because you do not depreciate any of the current assets. If you were talking about total asset, you would depreciate. I mean, you would subtract the depreciation because you can depreciate long-term, like equipment. You can use depreciation for equipment. So since equipment is not part of the equation, you don't need to use 200,000. Let me see if this is correct. Why we did not subtract the depreciation, the accumulated depreciation of $200,000 in this equation? I think my train of thoughts is right. Excellent question. The reason is that working capital only uses current assets and current liabilities. Current assets, cash, short-term investments, accounts receivable, inventory, prepaid. Okay? Non-current asset, patent, equipment, building, land, accumulated depreciation. If your question, in your question, equipment is non-current asset, accumulated depreciation is 200,000. Contra asset attached to equipment. You see, it is attached to equipment. So since we were not using equipment in this equation, we don't need to subtract the 200,000. That's good. This is good. So 660,000. Okay, so working capital. Working capital is current assets minus current liabilities. Easy. Current assets minus current liabilities. Working capital is current assets minus current liabilities. Okay. We are done with this set. Done with this set of questions. Let me see. We can attack on. Okay, so it's going to be time for break. It's going to be time for break in a couple seconds. So when we come back from break, we will attack another set of 10 questions, and then we will call it a day. Call it a day. All right, 13 seconds. Let me see. Do I have anyone here with me on YouTube? Do I have any message? No, I have no message on YouTube. That's fine. All right, so time for break, everybody. Let's go to break. We'll come back in 10 minutes.
Show current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect? Average accounts receivable over net credit sales times 365. How many days to collect? 365 over accounts receivable turnover. How many days to collect? Ending accounts receivable over net credit sales times 365. How many days to sell? Average inventory over cost of goods sold times 365. How many days to sell? 365 over inventory turnover. How many days to sell? Ending inventory over cost of goods sold times 365. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. plus ending equity divided by 2. Average equity beginning equity plus ending equity divided by 2. Average equity beginning equity plus ending equity divided by 2. Average equity beginning equity plus ending equity divided by 2. Average equity beginning equity plus ending equity divided by 2. Cost of goods sold beginning inventory plus purchases minus ending inventory. Cost of goods sold beginning inventory plus purchases minus ending inventory. Cost of goods sold beginning inventory plus purchases minus ending inventory. Gross profit margin, net income over sales. Net profit margin, net income over sales. Net profit margin, net income over average total asset turnover. Net profit margin times asset turnover. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Gross profit margin. Gross profit over sales. Gross profit margin. Gross profit over sales. Gross profit margin. Gross profit over sales. Operating margin. Operating income over sales. Operating margin. Operating income over sales. Operating margin. Operating income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin times asset turnover. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect average accounts receivable? Over net credit sales times 365. How many days to collect 365 over accounts receivable turnover? How many days to collect ending accounts receivable over net credit sales times 365? How many days to collect 365 over current liabilities? Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect average accounts receivable over net credit sales times 365? How many days to collect 365 over accounts receivable turnover? How many days? Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. A quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect? Average accounts receivable over net credit sales times 365. How many days to collect? 365 over accounts receivable turnover. How many days to collect? Ending accounts receivable over net credit sales times 365. How many days to sell? Average inventory over cost of goods sold times 365. How many days to sell? 365 over inventory turnover. How many days to sell? Ending inventory.
We're
over
back.
cost of goods sold times
Back from
365.
break.
Average accounts
It's a beautiful day out there.
Ending accounts receivable.
But we gotta come back here.
Accounts receivable.
All right, let's get it.
Average accounts receivable.
Let's get it. So let me see. We're going to attack another set of 10 questions. Hopefully we have time to do it in the next hour. All right. It's 9 o'clock. Let's do it, my friend. Never give up on your goals. Never give up on your dreams. It's not going to be easy, my friend. It's not going to be easy. But keep going. All right. If you're watching right now, leave some motivation. Say, hey, Wilkin, keep going. I'm going to read it. Just say that. Say, Wilkin, keep going. Okay. So financial statement ratio and performance metrics. Let's do that. I'm gonna take another set of 10 questions here. Okay. I need to make sure that music is not too loud. Okay, we're good. All right, so first question of the set. Assuming constant inventory quantities. Assuming constant inventory quantities, which of the following inventory costing methods will produce a higher inventory turnover ratio in an inflationary economy? All right. Assuming a constant inventory quantities. So the quantity of the inventory does not change. Assuming constant inventory quantities, the quantities of the inventory does not change. Which of the following inventory costing methods will produce a higher inventory turnover ratio in an inflationary economy? I need to scan this because for the explanation, we have FIFO, we have LIFO, we have moving average, weighted average. So, all right, no. I'm not going to take this time I'm not going to waste time on this. This is a logic question, but you need to understand LIFO, FIFO. If you understand LIFO, FIFO, we can do it. So let's do this. Okay. Let us see. This is a very common CPA question. Okay, formula. Inventory turnover equals cost of goods sold divided by average inventory. Yes, that's the formula. All right, inventory turnover is cost of goods sold divided by average inventory. In an inflationary economy, prices are rising. Okay, so prices are rising. FIFO sells the oldest cheaper inventory first. This is FIFO. FIFO means first in, first out. FIFO, first in, first out. Okay, so that means the first inventory you had on your shelf are cheaper because you bought them first. Now, we are in an inflationary economy. Whatever you're going to buy in that economy right now is going to be more expensive. Your inventory is going to be more expensive. So, but FIFO, say you first in, first out. So in FIFO, you sell the oldest and cheaper inventory first. What is the result? Lower cost of goods sold, higher ending inventory. What does that mean? A lower cost of goods sold, that means the cost of the inventory you are selling is lower. Why? Because you bought them for a lower price. You bought them before the inflation started. So the cost of that inventory is lower. So it's a lower cost of goods sold, a higher ending inventory. Why ending inventory is higher? It's because you have the more expensive inventory left, right? The inventory you bought in inflation, this is what you have left. So your ending inventory will be higher. So since inventory turnover equals cost of goods sold divided by average inventory, lower numerator and higher denominator, lower turnover. This is good. We need to understand that. Lower numerator and higher denominator, the result will be lower. Think about it. If your numerator is 5, your denominator is 10, your result is going to be 5 divided by 10, 0.5? Yeah, 0.5. If your numerator is 10, your denominator is 5. It's 10 divided by 5, your result will be 2. So if your numerator is higher, your denominator is lower, your result is going to be higher. Isn't what you say? Okay, lower numerator, yes. If your numerator is lower, your denominator is higher, your result is going to be lower. All right, so the result follows the numerator. The result follows the numerator. Okay, the result follows the numerator. The result follows the numerator. Yes, your numerator is lower, the result is going to be lower. Your numerator is higher, your result is going to be higher. Okay. So, in FIFO, first in, first out, your cost of goods sold is going to be lower, your ending inventory is going to be higher, Inventory turnover is cost of goods sold divided by average inventory. Your cost of goods sold is going to be lower in FIFO. Okay, cost of goods sold is going to be lower in FIFO because you're selling the cheaper products first in, first out. What does the question ask? The question is asking turnover ratio. Which of the following inventory costing method will produce the higher inventory turnover? So we need the one that's going to produce a higher inventory turnover. Which one has a higher numerator? Because the result is going to follow the numerator. Which one has a higher numerator? FIFO, you sell you first in, first out. You sell the cheaper products first, so your cost of goods sold is lower. And inventory turnover is cost of goods sold divided by average inventory. So cost of goods sold is the numerator. So whenever the numerator is higher, this is what's going to cause the turnover to be higher. We have LIFO, last in, first out. If we do last in, first out, that means you're selling the more expensive products first. Your cost of goods sold is going to be higher. The reason is because the cost of the inventory you're currently selling, the inventory is more expensive because it's last in. This is the last inventory you bought. Since it is the last inventory you bought, the price of this inventory, you bought it in inflation, so the price is higher. The cost of goods sold, the cost of the inventory is higher, and cost of goods sold is the numerator. So this one is going to cause the turnover to be higher. 1, 2, 3. Correcto. This is correct. That's good. That's good, my friend. I love this. I love that. If numerator is higher and denominator is lower, the turnover is higher. Okay? That's it. That's it. That's what you need to know. No math. Most of these questions are not math questions. They are just logic. But you need to understand. All right. Strom Inc. has current assets of $5,500,000. $5,500,000. Give me just a second. Let me do this real quick. Okay. All right. Strom Inc. has current assets of $5,500,000. Their current ratio is 2.0. or 2, and their quick ratio is 1.5. What is Strom's total inventory? Oh, total inventory. Strom has current assets of $5,500,000. Current ratio is 2. Quick ratio is 1.5. What is the total inventory? What? Okay. Based on what we have current assets. Current assets is 5.5 million. Current ratio is 2. So how do you calculate current ratio? Current ratio is current asset divided by current liabilities. So current asset is 5.5 million. What can we divide by 5.5 million to have 2? So 5.5 million divided by 2. 5.5 million divided by 2. Okay. Let's do 5.5 55, no. 5.5 million divided by 2 is 2,750,000. So that means if I divide 2,750,000 by 5.5 million, I will have 2,750,000, 5.5 million divided by 275. Okay, 2,750,000. It gives me 2. All right. So they say current asset is 5.5 million. Current ratio is 2. That means I have current asset and I have current liabilities. Current liabilities is 2,750,000. Okay, so I have current asset, I have current liabilities. The question is asking for what? What is total inventory? How do I get total inventory? Wait, I have current asset, I have current liabilities. Total inventory. I'm not going to do that. Let me scan this because this is giving me waste too much time. It should be just a really simple thing. Okay. I turned it down. This guy. You go to college. All right, so let's see. Okay, so step 1, current ratio is current asset divided by current liabilities, which we got. So we have that is 2,750,000. Quick ratio equals quick assets divided by current liabilities. So quick assets. So for quick assets, 1.5 times 2,750,000. Quick ratio, quick asset. Ooh, is 4 million. Quick asset 4,125,000. Step 3, find inventory. Remember, current asset equals quick asset plus inventory. What? Current asset equals quick asset plus inventory. I didn't know that. Current assets equals quick assets plus inventory. So inventory equals current asset minus quick assets. What? Inventory equals 1,375,000. Wait. Current asset minus quick assets. Okay. Inventory equals current assets minus quick assets. Okay. So what you need to find is current asset, find current asset, find quick asset. Quick assets 1.5. Quick asset is 4,125,000. Okay, I still don't get that because current asset is the current ratio. Oh, current ratio is 2, and quick ratio is 1.5. Okay. So current liabilities, we find current liabilities is 2,750,000. Current ratio. So current assets, quick ratio equals quick assets divided by current liabilities. Quick assets. Quick ratio, we have it. Quick ratio is 1.5. Quick assets equals quick assets divided by 2,750,000, which is current liabilities. So for quick assets equals 1.5 times 2,750,000. Quick assets equals 4,125,000. Okay. It's a little, this is easy, but confusing at the same time. Easy and confused at the same time. So 1,375,000. I'm gonna leave it like that because it's just that you need to think right. The current ratio and the quick ratio are related liquidity metrics that measure a company's ability to meet short-term obligations due within a year. Both ratios express the relationship between current assets and current liabilities. However, the quick ratio is the more conservative liquidity measure because it excludes inventory and prepaids in the numerator. Inventory is the least liquid current asset because it requires the longest time to convert to cash. To determine the company's total inventory, first use the current ratio formula to solve for current liabilities. Then plug the value of the current liabilities calculated in the first step into the quick ratio formula, bearing in mind there are no prepaids in this scenario to solve for inventory. Okay. Current ratio, current assets divided by current liabilities. Current liabilities, current assets divided by current ratio. Current liabilities, current assets divided by current ratio. Okay. Yes, current asset divided by current ratio. Okay. Yes. Quick ratio, current asset minus inventory minus prepaid divided by current liabilities. Yes. Quick ratio is quick assets divided by current liabilities. What did I do? Okay. Now, okay, formula for quick ratio. Rearrange inventory equals quick assets minus quick ratio times current liabilities. Inventory equals, okay, so you just replace everything. Plug in quick assets and and current liabilities for inventory. Okay. There was something. Inventory equals quick current assets minus quick assets. Inventory equals current assets minus quick assets. Current assets minus quick assets. Okay. All right, we'll come back to it. Current assets minus quick assets. Yeah, I still do not understand this completely. But let's keep moving. I'm gonna come back to this. I'm gonna come back to it in a minute. Farco is applying for a loan in which the bank requires a quick ratio of at least 1. Faro's quick ratio is 0.8. Which of the following action would increase Faro's quick ratio? What is quick ratio formula? Quick ratio formula is quick assets divided by current liabilities. So if we can increase quick assets, quick ratio will increase because the result always follows the numerator. So if we can increase quick assets, quick asset is cash, marketable securities, cash, marketable security, and accounts receivable. Cash, marketable security, accounts receivable. These are quick assets. If we can increase one of these, we can increase quick ratio. So let's see the options that we have. The question is, Farco is applying for a loan in which the bank requires a quick ratio of at least 1. But there is a problem. The problem is Faro's quick ratio is 0.8. We need to increase quick ratio. How do we increase quick ratio? We either increase cash or increase accounts receivable or increase marketable securities. Short-term marketable securities. One of these have to increase. So option A, purchasing inventory through the issuance of long-term note. That's not going to increase cash. If you purchase, you are reducing your cash when you purchase. So this is out of the question. Implementing stronger procedures to collect accounts receivable at a faster rate. Collecting accounts receivable at a faster rate. So people owe you money. Accounts receivable is when people owe you money. Let's say they owe you $5,000 and they were going to pay you in 1 year. You collect that money faster. You collect the accounts receivable, cash came in. But your accounts receivable is going to go down. So your quick ratio will not increase. It will not affect your quick ratio because the money that you had in accounts receivable, now it's converted into cash. Nothing happened because quick ratio has accounts receivable, it has cash. So it's just a transfer of funds from accounts receivable to cash. Cash increased, but accounts receivable decreased. So no change. Paying in existing accounts, account payable. Paying an existing account payable. If you pay, that means cash is coming out of your account to go pay someone. that would decrease. That would decrease your cash. If you decrease your cash, you decrease your quick ratio. Selling obsolete inventory at a loss. Selling inventory. If you sell inventory, you receive cash, but it says at a loss. Now, even if you sell at a loss, you still receive cash. You were supposed to sell it for $10, you sold it for $7. $7 cash came in. If cash came in, so your cash went up, your quick ratio will go up, even if you sold at a loss. Even if you sold the thing at a loss, but you increased your cash anyway, so that will increase your quick ratio. And that's right. That makes sense. All right, so last year, a segment of Dixon Company had the following sales, asset, and operating income. Last year, a segment of Dixon Company had the following sales, assets, and operating income. Sales, $500,000. Assets, $200,000. Operating income, $50,000. What is the segment's asset turnover? Asset turnover. Asset turnover. Oof. Asset. Asset turnover. Asset turnover. Inventory turnover is cost of goods sold. Accounts receivable turnover is net sales. Asset turnover is what? I don't know the formula for assets turnover. Inventory turnover is cost of goods sold. Accounts receivable turnover is net sales divided by average accounts receivable. So assets turnover. All right, let me see what it is. All right. Let's see. So this one straightforward. Asset turnover equals sales divided by assets. Oh. Asset turnover, sales divided by asset. That's it. All right. So you have sales, you have asset. Okay. So 500,000 divided by 200,000. 2.5. Wow. Okay. Remember this. Asset turnover equals sales divided by assets. Asset turnover equals sales divided by assets. Asset turnover, sales divided by asset. Asset turnover, sales divided by asset. Asset turnover, sales divided by assets. Asset turnover is sales divided by assets. Asset turnover, sales divided by asset. Asset turnover, sales divided by assets. Okay? Asset turnover is sales divided by assets. Asset turnover, sales divided by asset. Asset turnover, sales divided by assets. Okay? All right, asset turnover, sales divided by assets. That's good. Let's keep moving. 2.5. You have sales, you have assets. You can do it. Okay. Net sales divided by assets or average assets. Net sales divided by average assets. Sales divided by assets. Net sales divided by average assets. Same thing. Return on assets is net income divided by average assets. Remember that. Okay, so clip this. return on assets, net income divided by average assets. Return on assets, net income divided by average assets. Return on assets equals net income divided by average assets. Return on assets, net income equals net income divided by average assets. Asset turnover equals sales divided by assets, or net sales divided by average assets. Profit margin. Profit margin is net income divided by net sales. Okay. Return on asset, asset turnover, profit margin. They all have net income as no. Return on assets has net income as numerator. Asset turnover, net sales as numerator. Profit margin, net income as numerator. Okay, so return on assets, net income divided by average assets. Net income divided by average assets. Return on assets, net income divided by average assets. Asset turnover, net sales divided by assets or average assets. Sales divided by assets or net sales divided by average assets. Profit margin. Profit margin is net income divided by net sales. Net income divided by net sales. Net income divided by net sales. Okay? Clip that and remember it. So what's the relationship return on asset? Net income divided by average asset. How much money? Okay. Return on asset is how much money you make on your asset. So that's why it's money, net income divided by assets. Return on asset is money. How much money? Money. Income. Money, income. Return on asset, it's money, it's net income on asset. It tells it, like the answer is in the question. Return on asset is net income divided by assets or average assets. Net income divided by average assets. Return money on assets. Net income divided by average assets. Okay? Assets, asset turnover. Net sales divided by average assets. What's the relationship? Asset turnover. Asset turnover. Asset turnover. Asset turnover. How fast do you sell your asset? Net sales divided by average asset. How fast do you sell? How fast do you sell your assets? Asset turnover is how fast do you sell your asset? So it's net sales divided by average assets. Okay. Asset turnover is how fast do you sell your assets. So it's net sales divided by average assets, or sales divided by assets. Asset turnover means how fast do you sell your assets. How fast do you sell your asset? So it's sales divided by assets. Good. All right, got it. Profit margin. Profit. When you talk about profit, you talk about money. You talk about income. Profit margin. You're talking about income. You're talking about profit margin. It's income, net income divided by sales. Profit margin, net income divided by sales. Profit. How much profit did you make on the sale? How much profit did you make on the sale? profit margin. How much profit did you make on that sale? Right? It's net income divided by sale. Net sales. Net income divided by net sales. Hey, profit margin. What is your profit margin? So how much money do you make on that sale? How much money do you make on the sales? How much money do you make on them? What is your net income from the things that you're selling? What is your net income from the things that you're selling? What is your profit margin? It's net income divided by net sales. Net income divided by sales. If we understand what we're saying, it becomes automatic. Yes. Okay, cool. Let's keep moving. Keep going. Selected financial data. They give us a lot of information in this question. What's the question? At December 31st, year 2, raise quick ratio was what? Now we need to calculate quick ratio. To calculate quick ratio, it is quick assets divided by current liabilities. So that's what we need. They give us a lot of information. So what we need is quick asset. That's what we need to identify. We have cash. Cash is, let me see, for year 2, right? We have December 31st, year 2. Okay, year 2, $170,000 cash. Accounts receivable net $450,000. This is quick asset. Now let's see if we have short-term marketable securities. We have merchandise inventory. That's not quick. Short-term marketable securities, yes, 80,000. This is quick asset también. Also, I'm getting tired. When you see languages are being crossed, I'm getting tired. Land and building, this is not quick. This is long-term. Mortgage payable, this is not asset. Accounts payable, this is not asset. Short-term notes payable, this is not asset. Okay, so we have identified our quick assets. Quick asset is cash, 170,000. Accounts receivable net, 450,000. Let's do that. Let's do it. Oof. If you're watching here, leave me a little motivation here. Say, Will can keep going. Just say that. Okay, I'm gonna check the chat right now to see. Just say it. If you're watching, say, Will can keep going. I need a little motivation right now. All right. Okay. Let's keep going. Hey. What? All right, so what did we say? We say cash is 170,000. 170,000. Accounts receivable plus 450,000. Plus 450,000. We have short-term marketable securities, 80,000 plus 80,000. This is 700,000. Quick asset is 700,000. Now we need current liabilities. Let's see if they gave us current liabilities. Accounts receivable, merchandise, short-term land, mortgage, accounts receivable, accounts payable, short-term notes, net credit sales total, there, respectively December. They didn't give us current liabilities, so we need to identify current liabilities. Short land, mortgage payable, current portion. All right, 60,000. Mortgage payable, the current portion is 60,000. accounts payable and accrued liabilities. Short-term notes payable is 100,000. I don't know if accrued liabilities is a current liability. I'm gonna try that. All right, 700,000 as quick asset. 700,000. Okay. So current liabilities, mortgage payable 60,000 plus accounts payable and accrued liabilities 240,000. Short-term notes payable 100,000. 400,000. So it's 700,000 divided by 400,000. That would be 1.75. It would be 1.75. I'm not sure if that's right because I'm not sure if accrued liabilities would be considered a current liability. That's what I don't know. But let me select this to see. If it's not correct, that's fine. Correct. Okay, we got it. We got it. So the quick ratio is quick assets, cash, temporary investment in marketable equity securities, and net receivables divided by current liabilities. The quick ratio measures the ability to pay current liabilities from cash and near cash items. In this case, quick assets total $700,000 divided by 400 and, well, what do you say, plus 450,000. Okay, yes, okay, $700,000. And current liabilities total 400,000. Okay, resulting in quick ratio of 1.75. So what I was not sure about was accounts payable and accrued liabilities. Let me get an explanation. The bird came back again today. I know what to do for this bird, but this bird cannot be coming back like this and making noise. Okay, I need you to explain to me accrued liabilities. Why do we include accrued liabilities, accounts payable and accrued liabilities as a current liability? Why is that? And little c. Because current liabilities are obligations that must be paid within the next 12 months or operating cycle. Accounts payable, suppose you buy inventory on credit. Okay, inventory $1,000, accounts payable $1,000. You owe a supplier $1,000 and will usually pay it within 30 to 90 days. Since it is too soon, it's a current liability. Accrued liabilities. An accrued liability is an expense you've already incurred but haven't paid yet. Okay. Example, accrued wages, accrued interest, accrued utilities, accrued taxes. Example, your employees worked this week, but payday is next week. You owe the employees $5,000 and will pay them soon. Since it is too soon, it is a current liability. All right, that makes sense. Okay, that's current liabilities. Cool. A company reported the following items on its balance sheet at the end of the current year. Okay, it's a lot of things. We have common stock, we have retained earnings, deferred revenue, non-controlling interest, allowance for credit losses, accounts payable, note payable. What's the question? What is the company's debt to equity ratio at the end of the current year? How do you calculate debt to equity ratio? How? Debt ratio? What? Debt to equity ratio. Debt to equity is how much you owe on the equity that you have. So, how much you owe is your liabilities divided by your equity. Debt to equity is liability divided by equity. Let me see. Common stock, retained earnings, deferred revenue, non-controlling interest, allowance for credit losses, accounts payable, note payable. Let me scan that. I'm not going to spend a long time on this. Okay, I have a call. All right, somebody's calling. Let me see how long we have left. We have 20 minutes left. Let me complete that. I'm gonna take. Okay, let me take it. Persist. Hello, Ann. Bonjour.
Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. A quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. Working capital, current assets minus current liabilities. How many days to collect? Average accounts receivable over net credit sales times 365. How many days to collect? 365 over accounts receivable turnover. How many days to collect? Ending accounts receivable over net credit sales times 365. How many days to sell? Average inventory over cost of goods sold times 365. How many days to sell? 365 over inventory turnover. How many days to sell? Ending inventory over cost of goods sold times 365. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Beginning accounts receivable plus ending accounts receivable divided by 2. Average accounts receivable. Average accounts receivable. Beginning accounts receivable plus ending accounts. Accounts receivable. Divided by 2. Average inventory. Beginning inventory plus ending inventory. Divided by 2. Average inventory. Beginning inventory plus ending inventory. Divided by 2. Average inventory. Beginning inventory plus ending inventory. Divided by 2. Average total assets. Beginning total assets plus ending total assets. Divided by 2. Average total assets. Beginning total assets plus ending total assets. Divided by 2. Average total assets. Beginning total assets plus ending total assets. Divided by 2. Average equity. Beginning equity plus ending equity. Divided by 2. Average equity. Beginning equity plus ending.
All right, so let's get back. That was an important call. Had to take it. All right. So, well, we're going to scan this. Salaries, accounts payable, exempt current liabilities, equity, debt to equity ratio. What are we looking for? Okay. Let's do this. Time is going by so fast. All right, so for debt to equity ratio, use debt to equity equals total liabilities divided by what? Identify total liabilities include deferred revenue, accounts payable, note payable. Total liabilities equals 555,000. Identify equity plus what? Debt to equity, total liabilities plus T. Rewrite the formula. It says debt to equity equals total liabilities plus divided by T. What does the T stand for? Rewrite the formula in a way that is understandable. Yeah, I was saying debt to equity is liabilities divided by equity. That's yeah. I think we got it right. Oh. Instead of abbreviation, write it like this. Sorry. Debt to equity ratio equals total liabilities divided by total equity. Okay. I mean, I'm understanding this. Debt to equity ratio, we're calculating how much debt you have on your equity. Debt to equity ratio is debt, your total liabilities divided by total equity. So, debt to equity ratio, total liabilities divided by total equity. All right, total liabilities divided by total equity. Total liabilities equals accounts payable, notes payable, deferred revenue. Total equity, common stock, retained earnings, non-controlling interest. Then debt to equity ratio equals total liabilities divided by total equity. Okay. Debt to equity ratio, debt to equity equals what the company owes divided by what the owners own. Okay. The bigger the ratio, the more the company relies on debt rather than owner's investment. How do you calculate debt ratio? Not debt to equity ratio, but debt ratio. Debt to equity ratio. Debt ratio equals total liabilities divided by total assets. Okay, vertically. Total liabilities divided by total assets. What it means, debt ratio, what the company owes, divided by what the company owns. Okay. What the company owes divided by what the company owns. But debt to equity ratio is what the company owes divided by what the owners own. Okay? What the company owes divided by what the owners own. This is debt to equity ratio. Debt to equity ratio is what the company owes divided by what the owners own. Equity. What the owners own. So it's going to be total liabilities divided by total equity. But debt ratio is what the company owes divided by what the company own. Yes, what the company owes divided by what the company owns. Okay? So this is debt ratio, which is total liabilities divided by total assets. Excellent. We need to remember this. I need to see what to do with for this bird. Okay. So what did we get for the answer? This is frozen. I'm gonna take anything. There was 1.3. All right, so debt to equity ratio is total liabilities divided by total equity. Debt to equity ratio, debt to equity, is what the company owes divided by what the owners own. All right, debt to equity ratio, total liabilities divided by total equity. All right, total debt. Total debt ratio is total liabilities divided by total assets. Total liabilities divided by total assets times interest earned ratio, EBIT divided by interest expense. EBIT divided by interest expense. Find EBIT. EBIT is earnings before interest and taxes. So it's going to be net income plus interest expense plus tax expense. Okay. You just need to understand these things. Not really memorize them, but understand them. Okay. Which of the following ratios is appropriate for the evaluation of accounts receivable? Oh, which of the following ratios is appropriate for the evaluation of accounts receivable? Accounts receivable. Day sales outstanding, return on total assets, collection to debt ratio, current ratio, accounts receivable. I would say current ratio. Current ratio has to do with accounts receivable. No, current ratio calculates. No, current ratio has. Which of the following ratio is appropriate for the evaluation of accounts receivable? To evaluate your accounts receivable, to evaluate how soon you collect your money from people who owe you. To evaluate accounts receivable. Day sales outstanding, this is how long it takes for you to sell. Return on total assets, This is how much money you make on the assets that you're selling. Return on asset. Collection to debt ratio. It should be collection to debt ratio. This would evaluate accounts receivable. No, day sales outstanding. Day sales outstanding. Accounts turnover, net sales divided by average net. Day sales in accounts receivable is ending net accounts receivable divided by net sales times 365. Day sales outstanding. Which of the following ratios is appropriate for the evaluation of accounts receivable? Days sales outstanding. Collection to debt ratio? Is that even a thing? Let me get the explanation for this. The key phrase is evaluation of accounts receivable. Ask yourself which ratio tells me how quickly customers pay what they owe. Day sales outstanding? What? DSO. That is exactly what day sales outstanding, DSO, measures. Really? I thought it was sales, how long it takes to sell. Correct answer, day sales outstanding. Formula, DSO, accounts receivable divided by net credit sales times 365. DSO, accounts receivable divided by net credit sales times 365. Or DSO equals 365 divided by accounts receivable turnover. Why? Accounts receivable represents money customers owe the company. DSO tells us how many days it takes to collect those receivables. Whenever customers are paying quickly, or whether customers are paying quickly or slowly. Whether receivables are becoming harder to collect. Why the others are wrong. Return on total assets, not right. I know. Collection to debt ratio, not a standard FAR ratio. That was a trap. But they got me. Collection to debt ratio is nothing. All right, so it's not a thing. So day sales outstanding is how long it takes for you to collect the money they owe you. Day sales outstanding. DSO is how long it takes for you to collect the money they owe you. Okay, so let's keep going. We're almost there. We have 3 more questions left to complete this session. We're doing good. We're doing good. We are almost there. Okay. Almost. The question says main coal sales total 300,000. What happened? They says okay. Let me take this picture. Main coals. All right. Main coal sales totaled $300,000 for the current year. Main's cost of goods sold was $150,000. Main's accounts receivable balance was $20,000 on January 1st and $30,000 on December 31st. What was Main's accounts receivable turnover rate for the current year? Accounts receivable turnover. Accounts receivable is net credit sales divided by average accounts receivable. Accounts receivable turnover is net credit sales divided by average accounts receivable. Do we have net credit sales? Main coast sales total $300,000 for current year. $300,000 total sale. Main coast goods, cost of goods sold is in. Main's account receivable balance was $20,000 on January 1st and $30,000 December 31st. We have it. Okay, we got it. We don't need anything else. We got it because it's net sales, net credit sales divided by average accounts receivable. So average accounts receivable is beginning accounts receivable 20,000 plus ending accounts receivable 30,000. 50,000 divided by 2, 25,000. All right, 50,000 divided by 2 is 25,000. So is 300,000 divided by 25,000. That's what I would do really quickly. 300,000 divided by 25,000. That would be 12,000. Wait. Okay, yes, that's right. That's 12. That's 12. 300,000 divided by 25,000 is 12. 12 times. So the result is 12. All right, what did we do? The question is accounts receivable turnover. Accounts receivable turnover is net sales divided by average accounts receivable. You have sales, you have average accounts receivable, you have the answer. That's good. All right. Stantco. Whoop. Ew. Time. All right, so we need to finish this. We need to finish this before we leave. Stantco had total assets of $760,000, common stock of $150,000, and retained earnings of $215,000. What was Stant debt to equity ratio? Debt to equity ratio is total liabilities divided by total equity. Do we have total liabilities? Asset of common stock, retained earnings. Okay, we can find that. All right, total liabilities divided by total equity. Total liabilities divided by total equity. Debt to equity ratio. Total debt ratio is total liabilities divided by total asset. Times interest earned ratio, EBIT divided by interest expense. Okay, debt to equity ratio, total liabilities divided by total asset. No, total liabilities divided by total equity, debt to equity. Total liabilities divided by total equity, total debt ratio, total liabilities divided by total assets, times interest earned ratio, EBIT, divided by interest expense. Okay. So that's it. We will conclude our session. Thank you very much for sticking around. And have a great day. All right. Thank you so much for sticking around with me.
Operating income over sales. Operating margin. Operating income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin times asset turnover. Quick ratio cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio cash plus ratio, current assets over current liabilities. Current ratio, current assets over current liabilities.